All right, looks like we got the live stream going again finally. So took a couple days off from doing some YouTube videos focused on making articles for my Patreon account contributors. I'm also working on a Euro dollar and global macro article that should be out hopefully sometime this week. I've got most of it done. I have to add in some other details, but that should be out hopefully sometime this week. There are some things in there I really do not agree with Jeffrey Snyder about. Anyways, let's talk about the Jerome Powell 60 Minutes interview that came out yesterday on Sunday. So in the parts that we actually did see, the parts that those assholes at 60 Minutes did not edit out because they've been known to be absolute assholes about editing out with Mike Cernovich, with many other people. They edited out a lot of the best parts. So we're in the transcripts, if you read where Jerome Powell was actually talking about where there could be U.S. economy could shrink by upwards of 30% GDP drop. And I'm going to play some audio clips with David Rosenberg. He did a recent interview with Hedgeye. Going to play a couple minutes of that. Another excellent interview, too, that I will play audio clips of. It was on CNBC with, let me get the guy's name real quick, Stephen Davis, University of Chicago Booth School. He was on CNBC's Power Lunch. This is a 6-minute interview. I'll play a clip in a little bit. He did extensive surveying of the economy with business owners, and the results are not good. So I'll talk about that. I'll play the clip and then talk about that in a little bit. So Jerome Powell did say, and these are in the transcripts, you got to read the transcripts, unfortunately, because this is how stupid the mainstream media is, that there is, he did say this on the 13-minute interview, 13-minute and change interview, that there is no depression, even though he also said, and this was edited out in the transcripts, that there's going to be a 30% drop in GDP in the second quarter. But I guess, according to the CEOs of these publicly traded companies, that all the bad news is behind us now. That there's not going to be a second wave, that there's not going to be problems like George Goncalves was discussing, regardless of if there's a second wave with coronavirus outbreaks. George Goncalves, that interview I did with him on Friday, listed a number of other problems that could occur that would be a different type of second wave rather than just the amount of people infected and dead from the coronavirus. So he also said that unemployment could hit 20 to 25%, maybe even higher. He thinks, this is according to the transcripts that was edited out from the CNBC article, quote, "I think there's a range of perspectives, but those numbers sound about right for what the peak may be." So he's expecting enormous unemployment rates above what we have now. We have over 36 million now? So over 36 million now in over 2 months, 8 weeks. And an enormous amount of people that are still on the unemployment roll. So it's continuing claims. That continuing claims number is not going down. So there are a lot of adult Americans that are still on unemployment weeks, if not months. Well, over a month, maybe even over 2 months now at this point. So that the spike in continuous claims is actually jumping enormously. I'll play the clip with David Rosenberg in a second. Actually, let me go and play, before the David Rosenberg clip, which is about 5 or 6 minutes long, in the interview on Hedgeye, let me play this clip first that talks about the surveying in the real economy on Main Street. From Stephen Davis, University of Chicago Booth School, on CNBC Power Lunch from a couple days ago.
Why do you think that this job loss will be permanent?
It's great to be with you. Well, you cited the 42% figure. We got that in 2 parts. First, we surveyed firms in April and asked them, what fraction of your layoffs do you say are permanent? And that number was 23%. A recent household survey by the Washington Post actually got the same number. But then we did something else. We looked back, and historically we said, of the layoffs that firms and workers thought were temporary when they happened, how many actually led to recalls? And a good chunk of them never led to recalls. So we put that historical evidence together with the survey evidence from April to come up with our 42% estimate.
Right. Now, I could see back during, 08, 09, a lot of...
Okay, just quick interrupt. So I get this point across really quick, and then I'll restart the clip, the remaining 5 minutes or so. 42%, according to his data, and he'll explain more about it. And he's done extensive research on this, going back in past recessions and depressions, surveying current business owners right now who have had to unfortunately fire employees, even ones with SBA loans who are still paying them. According to him, 42%, and this is a lot of work on his part, 42% of the coronavirus-related jobs will be permanent.
The jobs that went away maybe wouldn't come back because you had a housing bubble and the bank sector, it was enormous, Wall Street. But in this case with the pandemic, why should it have the same effect? Why shouldn't it be the case that these job losses will prove temporary as people start to go back, return to their daily lives, so to speak?
Well, two big reasons. First, this idea that we're going to go into a deep freeze, and then when the thaw happens, we're all going to go back to things as it were. I think that idea has got serious problems and is partly wrong. We can see that in the kind of demand shifts that have already happened. Businesses are doing a lot less travel than they were before the pandemic. They're not going to go all the way back to where they were anytime in the near future. Airline travel is down more than 90% from a year earlier. The airline industry isn't going to come back to those levels in the near future. That's a lot of lost jobs. And then within sectors, like let's say healthcare, there's going to be big shifts. We've already seen a move to telemedicine, which is quite new in the US scene. That's not going to reverse. Some medical clinics, some doctors will be very adept at meeting the demand for telemedicine, customer preferences to avoid disease transmission risks, and others weren't. So we'll see a lot of shifts of that sort. There'll be a shift away from dine-in restaurants towards takeout and delivery. It's already happened, and some of it will stay in place.
Now,
there's one other thing to keep in mind.
Ahead.
Yeah, one other thing to keep in mind is in the past, when we had temporary layoffs, most of them came back within 2 months, the ones that came back. But this pandemic recession looks like it's going to go on much longer than that. And that means many of those so-called temporary layoffs will never result in recalls.
The thing about your research that I also thought was very interesting is most people who come on and tell us it's going to effectively be a depression or a terrible event say, and that's why we need $8 trillion of stimulus and more from Congress and more from the Fed and internationally coordinated. And you guys have a very different sort of response that you think is appropriate. You say that instead, the best way to make sure the economy comes back more quickly is to remove barriers to a faster recovery. And that includes unemployment benefits that exceed worker earnings, subsidized employee retention, occupational licensing restrictions, regulatory barriers to business formation. Now, anyone who's been out there, trying to open a business knows exactly what you're talking about, but there's rarely appetite for this kind of response. Why would this time be different?
Okay, just stopping it for a second here. So he's actually suggesting that there's more capitalism, more free markets, less rules, less regulations, less taxes, less government. I'm totally shocked that an economist is actually, a non-Austrian school economist is actually recommending this. This is a common sense solution that will probably, unfortunately, not be adhered to. But at least he's got the right idea.
Well, first let me say that there is a role for monetary and fiscal policy. But there's also an important role that's been overlooked for these other policy tools. And let me start with the unemployment insurance one that you mentioned. A new study by some of my colleagues finds that if you look at the bottom 1/5 of wage earners, they're getting paid twice as much on for unemployment benefits as they were paid when they were working. Now, you don't need a PhD in economics to figure out that's a very strong disincentive to going back to your old job. And it's a very strong disincentive to move to a new job if your old job's not coming back. That kind of policy discourages and delays this reallocation process we need. Don't get me wrong, there's an important role for unemployment insurance benefits to help those workers who have lost their job. But paying them more to not work than to work is not a very good idea in my view. Likewise, let's take the way the U.S. government has responded to the airline industry problem. Right now, the U.S. government is paying the airlines to keep their employees on payroll till October. Well, newsflash, the airline industry is not coming back to where it was in October. So as soon as October rolls around, there's two choices. Either taxpayers continue to pay airline employees not to work, or there's going to be large layoffs in the airline industry. That's just delaying the kinds of reallocation that we need. You mentioned several other things. Occupational licensing restrictions is a great example. During the crisis, Governor Cuomo said, wait a minute, don't we want out-of-state healthcare personnel to come to New York and practice and help our patients in New York? Of course we do. But it ran into occupational licensing restrictions, which are typically at the state level and prevent healthcare personnel and many, many other kinds of occupations and jobs, prevent people from working across state lines. We got rid of that. I hope, at least temporarily, I hope that kind of thing is permanent so that the economy can more quickly and adeptly respond to the kinds of shifts in the nature of labor demand that are taking place because of the pandemic.
Well, I encourage everyone to read the working paper. I linked to it in my newsletter, and it is a fascinating dive on what this might all look like coming out the other side. Stephen Davis, thanks so much. We appreciate it.
Okay.
Thank you.
Okay, that's it for that clip. Very good clip. Really good analysis there. A lot of the problem here is government intervention, whether it's the Federal Reserve, whether it's the states offering the workers too much unemployment, way too much. Not that, well, really, no one should get unemployment, but they're offering people so much in unemployment that there's no incentive. The incentives are broken to come back to work. If someone's making double the amount of money not working, do you think they're going to go back to work? Maybe a few people. Probably not most people. It's really sad. Then you have the study that came out from Open Table that 1/4 of American restaurants won't reopen. This came out, May 14th, so a few days ago. I think that number is going to be low. From what I'm hearing from locally, other restaurant owners, the number is going to be low. It's a mess. The restaurants that do not transition to takeout and delivery, it's a disaster. Have you seen any of the stuff online with the restaurant owners who are screwing this up with like the sex blow-up dolls, putting them in tables and chairs, and some of the other ridiculousness? There was one other funny thing I saw a few hours ago. I totally forgot. Just ridiculous. I can't believe the restaurant owners are doing that. Okay, so let me play this other clip. David Rosenberg, who is my favorite Keynesian economist because he looks at the data, and I would call him a rational Keynesian more than the other ones. So I like his research work a lot. He has a lot of good market calls. I don't agree with everything he says because he is a Keynesian, but he tends to understand a lot of the data in the real economy better than other Keynesians. So let's just play this clip, what he's talking about with the real economy, jobs, unemployment, GDP disaster, what he's talking about with the Atlanta Fed, not what Jay Powell is saying or what was edited out. This interview came out today on the Hedge Eye YouTube channel if you want to listen to the full hour plus. I'm only going to play about 5 minutes.
You know, for me, the labor markets, you get new data every Thursday with jobless claims. Obviously, we wait until the end of the month to get the summary of that. But there's a series of lags on that. Every one of these that I've risk managed through, Thursday's the day, right? So Thursday's the day where I can, look, as a bean counter, I'm either going to be proven wrong or I'm going to be proven more right. I mean, to your point, I cannot believe these numbers. I mean, and there's no model I could put them in, obviously, that goes back any cycle. And I wonder if that's just it. Like if the permanence to job loss is something that you have any higher confidence interval in. Like you said, you can't. Anyone who says they're 100% certain is completely full of shit. But I mean, when we talk about confidence intervals, do you have any confidence interval on the permanence of job loss as opposed to what many have hoped, and hope again is not a risk management process, but many have hoped has been temporary?
Well, you know, the answer to that is I do have a certain level of confidence about that, and the information that we got, for example, out of the last two employment reports. You know, I continue to hear over and over again from the bulls that over these past 2 months that close to 80% of the job losses were people who told the BLS that their employment loss was only temporary. Now, maybe it's wishful thinking, maybe it's true. Let's assume that they're correct, as if anybody really knows. But nobody seems to grasp what the 20% of the carnage so far has been permanent. And we're talking big numbers here. I mean, this would mean that 5 million jobs aren't coming back. That's more than 2 years of job creation right there that's gone for good. And that could be even underestimating the situation, because I saw a survey cited on Real Clear Politics. This was a couple of weeks ago. It was a survey by the Society for Human Resource Management, and it actually found that 52% of small businesses expect to fail in the next 6 months. And actually, if you go to the Fed's stability report that it published on Friday, there might be a lot of credence to that view about how many companies, especially small companies, just aren't going to make it. And so then all of a sudden, you're not talking just about 5 million jobs not coming back. You're talking about more than 10 million jobs not coming back.
Yeah, that'd be huge.
And that's the one thing. Like when you look beneath the veneer, and you're taking a look, for example, at the household survey as the companion to the payroll survey that came out a couple of weeks ago. You know, the labor force participation rate went from 62.7% in March to 60.2% in April. That's the lowest it's been since February 1972. What really caught my eye, and this comes down to your question about the permanency, is that the number of people, you know, who didn't even bother to get classified as unemployed, but actually went from employment to outside the labor force altogether.
Right.
That number skyrocketed by 3.6 million. That is off the charts. The only other time in history that we ever saw a number close to that was 1 million people disengaging like that in one single month. This was 3.6 million. So this is what we're talking about here, and is about the permanency of the job losses. You know, right now we're just living in the moment. We're in the early chapters. Whether or not this is a man-made recession or not, that this was not done by malfeasance, or, you know, I've got to say, by the way, the fact that Jay Powell has the temerity to say that there was no bubble, and yet, I mean, you're looking at corporate debt to normalized by any measure. It was so clear there was a bubble on the corporate balance sheet. It was the biggest debt for equity swap on record. But okay, the reality is that we have a situation where a health tragedy morphed into an economic tragedy. And I really don't know, Keith, anybody talking about the extent to which this is going to become a financial tragedy. Was anybody talking about, even when we were talking about the lockdowns at the beginning, was anybody talking about that the Fed would be actually expanding its balance sheet at twice the rate it was in the great financial crisis? That this would actually be multiples bigger than after Lehman and AIG collapsed? Who would have ever thought? And it just goes to show how leveraged the economy was.
Well,
Okay, it is a great interview. It's over an hour long if you want to listen to the rest. After what he said, all the data points, Jerome Powell says it's still not a depression. Meanwhile, fake libertarian Mark Cuban is talking about how people need to get even more checks to spend, that we need to create more demand. This is a supposed libertarian. He wants even more checks printed out to people to spend, to get consumer demand. Why? Probably because he has a lot of investments in consumer businesses. Not just his NBA team, a lot of other investments that you've seen on Shark Tank and elsewhere. So all of his businesses are consumer businesses. Guess what? A lot of the consumers don't want to spend as much right now. They don't have as much discretionary income unless they're actually making a lot more money on unemployment than they were at their regular job. Or they're actually like me and their online business is growing. But I think I'm an exception to a rule, because most people are not having the success I am with my online business right now. It's unbelievable, actually. I've beat the odds. How good things are going right now. I'm still shocked. I mean, I worked my butt off, and finally things are going my way. Okay, so let me see here. Got a couple more articles to talk about. We have this bill that was passed by the House of Representatives on Friday. Now, if you're not American, it has to be a similar version, the same or similar version has to be passed by the Senate. So there's another round of stimulus checks, another bailout or stimulus round that was passed by the House of Representatives already on Friday. However, it looks like the Senate's not going to pass that as of now, but that doesn't mean in a week, in 2 weeks, in 3 weeks, in a month, maybe longer, similar or a little bit different version is not passed. And that would be another $1,200 check to individuals, a maximum amount of $6,000 per household. I have an article here if you want to read the exact details. But as long as the dollar index is, the dollar index is hovering above 99, almost to 100 at 99.66 when we're doing this live stream show. As long as the dollar index is at these levels, there's a lot that the Fed, there's a lot that Congress can get away with in terms of spending. And one other thing I forgot from that Jerome Powell interview, and this was talked about by a lot of financial professionals, is that there was an infomercial from Jerome Powell on that 60 Minutes interview. This was not edited out, where Jerome Powell was talking about fiscal spending, and there was a wink, wink, nod, nod to Congress that, hey, Congress, if we lend it, if we, the Federal Reserve, lend it, you can spend it. Wink, wink, nod, nod. So that's basically saying the Federal Reserve, Jerome Powell, head of the Federal Reserve, chairman, was basically saying in his 60 Minutes interview that he is giving Congress a license to do, people are calling it MMT Lite. It's MMT Lite or MMT. And the Republicans have folded like a lawn chair. Because for the last couple of years, Republicans were adamant they would not do this. And then as soon as asset prices fell, as soon as the cash flow problem pervasive throughout all levels of society happened, and yes, central bankers and Congress can send out checks, but that doesn't fix the cash flow problem. It temporarily maybe helps things. It papers over asset prices. It does not fix a cash flow problem because cash flow is generated consistently. And guess what? A $1,200 check from Congress that you're getting, not consistent cash flow. Okay? Congress is not getting consistent tax revenues from productive economic activity. So the cash flow problem is not fixed. It may have been temporarily papered over or delayed, but it has not been fixed. I got an argument with someone on Twitter about this. Claimed to be a CEO of a technology company. Wonder how much economics or he actually knows. Probably has an economics degree from a major university. Gold price is still above 1,700, so dollar relatively strong. Gold price is up. People saw the Jerome Powell interview on Sunday and thought, oh, they're going to give Congress the ability to spend more, a lot more, depending on the dollar, the exchange rate of the dollar. Oil prices have rallied. But I think, and I will probably leave most of my comments for another article update for my Patreon account contributors. There's a lot of supply that could come back online very soon for oil production. So even though some companies are shutting in wells, other companies have said if oil prices go to $35 a barrel or higher, they could restart oil production. And there is also a lot of oil storage now, oil tanker storage, enormous amount. I have a chart of that I'll probably save for an article for my Patreon account contributors and then do some analysis on that. For my, I think it's over 1,000 now, Patreon account contributors. It is growing very, very rapidly. So thank you very much if you've stepped up. It's only $5 a month. The price of an overpriced cup of coffee. Who knows what price that'll be, though, in the near future. Maybe that'll be $6 or $7 for an overpriced, mediocre cup of coffee with the inflation and supply chain problems, monetary inflation that we have. That brings me to the super chat here with Garage Builds. I did a pretty smooth intro there. Please discuss inflation. I'm only 60% convinced Japan does not have I'm only 60% convinced, period. Japan, talking too fast. Japan does not have hyperinflation. So it is complicated. I have a couple articles about this behind the Patreon account paywall about distortions. There is monetary inflation, Garage Builds, and a lot of that monetary inflation over the last couple decades has gone into asset prices. So stocks, bonds, real estate, over-the-counter derivatives to help suppress some commodity prices. If you want to read a very old article about 20 years ago from Peter Warburton that was on the Gold Eagle, and I think Gata website had it too, talking about how a lot of the monetary inflation is hidden in the derivatives market to help suppress commodity prices. So there has been a ton of monetary inflation. Now, most people only think of inflation, that's the Austrian school of definition of inflation, is an increase in the currency supply and credit. And then higher prices are a symptom. They are not the cause of inflation, they are the effect. So most people think that because prices are not going up, that there is no inflation. But what restaurants, what food producers that make stuff that goes in the grocery store, what consumer staple companies do, is you get less goods and services for more dollars or euros or yen. So that is the trick. That is why inflation does not appear so bad. Also with Japan, a lot of it is hidden. They use government doctored their economic data is heavily doctored along with the US and many other governments. Inflation is intentionally underreported. There's an incentive to underreport inflation here in the US. I explained this in the article from cost of living adjustments. So Social Security payments, government employee pension funds are tied to a consumer price index. So it is in the US government's best interest to drastically underreport the inflation rate. So Japan has created an enormous amount of monetary inflation, but they have exported a lot of that monetary inflation out of Japan with the yen carry trade. So hedge fund managers and investment bank portfolio managers could borrow that yen, and Japanese pension funds could then invest that yen outside of Japan. So a lot of that monetary inflation that Japan has created for the last couple decades, 3 decades or so, it has created bubbles and higher asset prices in other countries. The problem now, Garage Builds, is all these governments are all copying Japan, and they're all trying to do it. And then you have supply chain problems. So we're probably going to get much, much worse stagflation soon. We already have it now in China for rent and food prices, especially pork, but also I'm hearing some vegetables, certain vegetables. And stagflation is going to increase here in the US a lot because of the supply chain problems. I covered this in depth. I put out another article early this morning about that with stagflation. There was one in last week too, behind the paywall on my Patreon explaining this. So while everyone is screaming about deflation, your grocery store bills will probably go up. Even in the Bureau of Labor Statistics' own government data for the month of April, we had the biggest spike in a single month in 50 years for grocery store prices. So this is even with a bias to underreport inflation in the Bureau of Labor Statistics data, that we had a big rise in grocery store prices, the largest single rise in a month in 50 years from the Bureau of Labor Statistics' own data. So I don't know about how soon hyperinflation, but we're going to have worse stagflation, and the price of everything is not going to go up. It's distorted. Certain things are going to go up more than others. The prices of some consumer discretionary items may go down. I talk about this more at length in the 2 articles behind the Patreon account paywall. Okay, another super chat from Wally. Thank you for the $5 super chat. Do I expect oil to go negative tomorrow? That would be crazy. I don't know what's going to happen in the short term. I do know there are storage problems still, but I'm not sure. There was software breaking. So there was a lot. It wasn't just storage why oil prices went negative. There was a lot of screw-ups with Bank of China. My friend Emma Molman, who's a hedge fund, she works in a hedge fund as an analyst and a portfolio manager, and she thinks that the Bank of China, because the stories have come out that a lot of customers at the Bank of China were offered this oil, like USO and oil derivatives futures product, and they ended up losing, a lot of them ended up losing enormous amount of losses. Now, I've seen different amounts of losses quoted. So a lot of the regular articles in the mainstream, a lot of the mainstream media articles have said it's 1 billion in losses, the Bank of China, from customers. Another video from China in Focus said it was 4 billion. But speaking with Emma Molman more, she thinks that the losses were actually over $100 billion in derivatives losses from the Bank of China. So for their own trading book, because they traded in the over-the-counter derivatives market, and then also their customers. So there was billions in losses. She thinks, this is her thesis, there was billions in losses. This is one of the major reasons why oil prices went negative. So you had a perfect storm, a confluence of factors with storage problems. People did not want to take delivery. There was no place to store a lot of the oil. And then you had derivatives, oil over-the-counter oil derivatives market problems with the Bank of China. They were caught off guard really bad. And then you had all these, you had Bank of China's customers with those bad oil derivatives trading products that also lost a lot of money. And then you had trading services. There's a lot of articles that have come out about this, like Interactive Brokers. Their trading software broke. So there was a recent article that came out about this with a day trader who was buying contracts and for Interactive Brokers, and Interactive Brokers trading software broke, and this guy kept buying enormous amounts, and this is why you should not trade on margin. This is very, very dangerous. This guy risked, I think he kept buying the dip with leverage oil futures contracts, thinking that the oil futures contract price could not go lower. And he had, I think, a $77,000 trading stake, and he way over leveraged. He had way too much exposure. He didn't hedge to his oil futures contract position, long oil futures contracts, on the day that people were taking delivery too. And this guy ended up owing and then the Interactive Brokers trading software broke when the price went negative, and I think he owes $9 million. So it was a confluence of factors, I would say. Now, I don't think I don't know if we'll see that again. We could, but I'm not going to bet on oil prices going that negative. What, it got to negative 40 something dollars a barrel? I don't know. We do have a supply. We do have a lack of demand in the oil market still. I have not seen any data that demand is really starting to rapidly rise. China was starting to restart their economy, but earlier today we saw that more parts of China, provinces are being locked down. I think over 100 million people. Parts of Germany, South Korea, others, they're starting to get second waves and back on lockdown. And then the coronavirus outbreak is starting to spread, I think, again in Wisconsin and Texas and other parts. So we do have some economic restart, but we're also seeing more people get sick. So I don't know if we'll see negative oil prices tomorrow. For now, the trend is up. But like I said earlier, about 10 minutes ago, the higher oil prices go, the more likely it is that more supply is going to come and hit the market again. And I'm not convinced that there's any data points out there that demand is coming back yet. Okay, if oil does go negative, second part of the question, if oil does go negative and should the problem continue every month, how will this affect the grand scheme of things? I think some of these trading companies, Interactive Brokers, I haven't seen any press releases where they fix the issue with their trading software. So you might see some of these companies, these trading companies, cancel the ability to trade the day the contract. You might see those cancel, or tell their customers that they have to figure out their oil futures contracts a couple days before. So there's no one gets stuck with all these futures contracts and they can't take delivery. You might see, or they have nowhere to, or they try to take delivery and have nowhere to store it. You might see something like that. I mean, even the USO has transitioned a lot of their oil futures contracts, so there's less problems with the USO. I'd have to study it more, but to see if the USO is in better shape. But a couple of hedge fund managers have told me that they think the USO is better and they've started to buy. I still think there's big problems with the USO, especially with tax consequences, but I haven't studied it enough to speak about that more in depth. If the USO is really, if the people managing the USO have really fixed things. I still think there's tax issues. Again, I think it should be a physical commodity storage ETF where they actually have good places to store the physical oil. You can buy units of this commodity ETF. You can lock in a long-term capital gains tax of 10% for buying and holding the ETF, and then the people managing it, all they do is they buy oil when it's cheap, they hold it for 6 months or a year, 18 months, 2 years, and then they sell it for when it's expensive. And then you can get a lower long-term capital gains tax by having that. That would be a good investment product compared to what the USO is. So it's tough to say if USO is going to go negative right now. Excuse me, not USO go negative. If the oil futures contracts will go negative right now when we're doing this live stream show, I have the tradingview.com up, and the light crude oil futures contract, which is the main one, is up almost 2%. I'll just hit the refresh button. So it's at $32.16. So it's a little under 2% at 1.61%. I didn't hit the refresh button. So if we were seeing a downtrend, if we saw oil maybe fall out of bed, I would start to get worried. I would watch that. So if you're going to stay up, Wally, if you're going to stay up and you're going to watch the oil futures contract and you're going to see oil start to go gap down, limit down, down $5, down $10, that would be a warning sign that it might happen. But so far, I don't see that. Okay, super chat from Peter. Thank you for the super chat. If market rolls over again, will gold stocks too? It's a possibility, but my thesis is that generalist portfolio managers who hate gold and hate gold stocks and cannot buy physical gold are accumulating the best gold stocks on dips, the best and largest and most liquid gold stocks. And by liquid, I mean there's trading volume to move in and out of positions. Because if you're a large portfolio manager, you can't go, if you're a very large portfolio manager, let's say you have a couple $1 billion in assets under management, you can't go and buy your entire position of Sandstorm Gold or a Cisco Gold Royalty or a mid-tier gold miner. You can't buy all of your position at once. I talked about exactly how this is done in an article for my Patreon account contributors. It's called a drip feed. So if you are a large portfolio manager or a hedge fund manager or a mutual fund manager, if you want gold exposure and your bylaws, or pension fund manager, so if you're an institutional investor, pension fund manager, and you're not allowed to buy physical gold or even the GLD, it would depend on your bylaws. The way you would get your gold exposure, even if you hate gold, but you're convinced with the global macro picture that the central banks are going to increase their balance sheets and do crazy things with interest rates, you would want gold stock exposure as a proxy to higher gold prices. So these are, in my opinion, what has been happening now for at least a month is that generalist portfolio managers are starting to add, this is what Eric Sprott has been, billionaire resource investor, Eric Sprott has been predicting for years now would happen, is you're starting to see these money managers, mainstream professional money managers that most, and I've interviewed a lot of these guys over the years in the archives of my channel, and I've asked them about gold. There's interviews of some of these guys in the archives, and they hate gold. Like, we're talking, they hate gold stocks, they hate physical gold. You know, some of them off the record, when we're not recording, they'll admit, yeah, I own a bunch of physical gold and silver in a safe, but I hate it. So it's just an insurance policy. And they are, in my opinion, accumulating gold stocks now. So if there was a dip in gold stocks or another market crash, I think the gold stocks would probably start to recover first. Anyway, at the current gold price we have now, the margins are going to be very good, especially for those open pit gold miners that use a lot of oil. Well, now that oil's rallying a little bit, the margins might not be as good, but gold prices are still holding up firm. The margins are still probably going to be pretty good. I would watch the oil price, though. So for some of these, if the oil price rallies still, there could be a lot more supply that comes back online. The oil price might crash again. We need to see demand come back. I have not seen any data that demand is starting to really firm up and start to increase substantially. So I think smart money, to answer your question, in my opinion, I think smart money is buying dips on gold stocks. Now, that doesn't mean gold stocks won't fall, but I think the Franco-Nevadas, the Royal Golds, the Wheaton Precious Metals, the Sandstorm Golds, those types of companies, those are the ones, the Newmont Minings, the Agnico Eagles, there's others, not going to mention all of them, but those ones are being bought first. So it's an accumulation method. People are like, how come my gold stocks don't go straight up? How come my gold stocks are selling off? Could be a money manager, could be a hedge fund manager that took some profits. The dips, I think consistently the dips are being bought. Okay, last super chat here from Durf Narf. Thank you for the super chat. Hey Jason, I have $21,000 left in student loans. He could pay them off by October with the current budget. Stash cash versus slam down to pay off loans is your what do you mean slam down? Your dilemma. Oh, your nurse. Forgiveness on horizon. Thoughts? Yeah, I don't know timing of student loan debts being forgiven. We don't know. That's something maybe I should talk about in emails that you should send me. I don't know the rest of your financial situation. I would not load up on debt and gamble that Congress for sure is going to wipe everything. It's a possibility, but I would not gamble my financial future that they're going to wipe everyone's student loan debt clean. Now, I know a lot of people have. There's been a lot of people that have over $100,000 in student loan debt, and they're hoping that, well, they were hoping that Bernie Sanders was going to win the DNC nomination and he was going to be president and he was going to wipe it clean with MMT. There's a possibility we could still get that because the Republicans seem to be at least somewhat on board with MMT. A lot of it depends on the dollar, though, and how much Congress can get away with. It's tough to say. If you can pay off $21,000 on your own with your work, paying off debt's never a bad thing, in my opinion. I am almost 100% debt-free. So it is a good thing. Like a couple more months, I will be 100% debt-free. I've worked very, very hard. And then hopefully the only other time I will use debt in the future is when there's cheap rental properties for cash flow. Although real estate's not cheap right now, but who knows? Maybe in the future. Because some of the richest people I know, they all have a lot of real estate investments. Okay, we are over 40 minutes. This is longer than I wanted to talk. My voice is still good, though. Shockingly. Okay, I want to thank everyone for listening. The articles discussed, if you want to go more in depth, and the other interviews I played clips for will be at the end of the video or in the information and description section. Thank you so much to my over 900, now over 1,000 Patreon account contributors. You're really making things so much easier in my life. I could focus on content, research, information, analysis, and financial education to try to provide value. Someone was telling me that I should only do stock picks behind the paywall. One thing that a lot of retail investors are not good at, and I've had discussions with thousands of retail investors now in the last 10 years. One thing retail investors are not good at is risk management, assessing risk. That is cost benefit, risk versus reward, position sizing, when to take gains off the table, positions being too big. Often risky positions being very risky positions being too big, or if you have gains, not pulling gains out. In fact, my stalker, who probably is still hitting the thumbs down on every single video, who used to live around here, he had a major issue with that. He put hundreds of thousands of dollars in 2009 and 10 into the riskiest junior mining stocks. He had hundreds of thousands of dollars in profits, and then he did in paper gains. He did not take any money off the table. He did not hedge. He did not take any profits off the table. You should learn from him. Learn from his mistakes. Do not blame me because I interview experts and make YouTube videos. He actually had an accounting degree and an MBA. He was older than me, but he can't take any responsibility for his actions. Okay, I'm going to end the rant there. So one thing, retail investors, it's all about risk management, risk assessment. A professional money manager, someone who manages either their own money professionally or manages money for clients. This is something they understand very well. This is something that most retail investors and most investment newsletter writers do not talk about. And unfortunately, when I worked in the paid investing newsletter business, when we tried to talk about it, people just ignored it anyway. We used to come out with newsletters once a week or once every 2 weeks, and it would be written in all capital letters, have a diversified portfolio. There was at my day job at that time, there was a bunch of different stocks in the model portfolio for each investment newsletter, and guess what some people did? They didn't buy all the different stocks or even a couple different stocks in the model portfolio. They bet it all on red number 10. There was people there relying on income, looking to gamble, who put $50,000, $100,000, $200,000 or more sometimes. I'd get people on the phone because I was a junior analyst back then, customer service phone calls that all the other senior analysts dumped the customer phone calls on me, and I wasn't the one writing the articles, so I got stuck with that duty, paying my dues. And the person would be chewing my ear off on the phone. You recommended this one stock, and I put all my savings into this one stock. Sir, Did you read any of the stuff about the model portfolio? It was in all capital letters, an entire paragraph below every single stock pick in the model portfolio, that you should not put all of your savings into any one stock. Yeah, I read that, but I didn't even... Yeah, this story sounded better. I mean, you try. Okay, I've had enough rants for today. Thank you, everyone, for listening.